Hi, everybody. Thanks so much for joining us for another one of our occasional Money Talks segments. I'm Susan Wornick, and I hope that you know by now that when you see us on the station, we have some important information for you. Everybody says your health is the most important thing. It is, but guess what? So is your money. And if you don't have good information about that, well, it's not a good plan. So I have three experts with me today who are going to help answer some of the biggest questions. I'd like to introduce them. Sitting to my immediate right, Mr. Michael Feiner, who I have known personally for how many years, Michael?
Oh, more than 20 at least.
A lot more than 20. Okay, let's just be clear about that. And Gary Coon, also Gary and I for a long time have worked together. And David Henry joins us this morning. David, it's great to have you with us. Thank you so much. I think everybody these days is talking about the stock market. Who wants to take on that first? Who wants to start? Mike, what's going on?
Well, it's interesting. The stock market has reached a new all-time high, just crossed 22,000 over the last couple of weeks, and is reaching really successive all-time highs for the last several months. And even though it's inching every day towards new highs, people have been asking, why is the stock market reaching new highs? And most importantly, is it time to sell? Is it a time to hold? Or is it a time to possibly get in toward higher highs?
And the answer for everybody, if you only had it, right?
If we only had a fortune, if we were fortune tellers, we could. But I think as a general rule, we do think that there are strong fundamentals, in the U.S. economy and the world economy that supports the stock market. And I'm sure that we can, provide, more insight as to why we think the market has gotten to where it has over the last year or so.
I see, Dave, you're shaking your head. Gary,
No,
you're
I
shaking your head.
agree wholeheartedly. I think I would almost like to refer to this as a Goldilocks type of situation where it's not too hot, not too cold. But in looking at it, I think there's two aspects. There's the positive aspect, and Mike certainly touched upon a few things. We're in a very robust market, but we also, it's coupled with good global economics. We're finally seeing the tailwind that the foreign markets have provided.
Really? I mean, I think that a lot of people hear about things going on in Europe and wondering what.
Well, Europe is, of the three major economies, probably the weakest. But when we look at various indices, the all-world indices right now, year-to-date, is up 18%.
I see.
With Asia contributing the bulk of it, up 30%, and that's Japan, China, and the other Asian economies and stuff like that. So, I mean, I was talking about Goldilocks because there are a number of different things that currently look very great. I mean, you think about the last employment data, we're at the lowest we've been in a long time, 4.3% unemployment rate. We also have interest rates that continue to stay at a historically low rate at about 2.3% for the 10-year, coupled with a very benign inflation rate, which helps keep that interest rates low. So those are all very positive factors, I think, helping to keep the stock market continuing the way it is right now.
Gary?
Yeah,
I need to hear you weigh in.
Exactly. I think there's several factors that we look at to say, how do we get to where we are and where might we be heading? Dave touched on some of the issues that relate to the macroeconomic type circumstances with respect to interest rates, with respect to inflation, et cetera. We also look at our companies making money. We're looking at the investment world and our companies continuing to have earnings so that the value of their companies can grow and the value of your investments can grow. And actually, corporate earnings have been quite strong. We're sort of, as we tape, in an earnings season, and the vast majority of the companies have been beating what the analysts anticipated that they would be making. So those continue to be strong. And then the other thing that we look at is the political backdrop.
I was going to ask.
And I think you touched on that in terms of some of the geopolitical type things happening. You hear about North Korea, or you
Most
hear about
recently,
exactly.
Sure.
So that's something to be. Those things tend to be, are important to look at. They tend to have sometimes some shorter term impacts on the market. But we're looking at all three of these areas and how they interrelate, and sort of come up with a calculus as to what we think based on that. And we think, particularly just going back to the United States, regardless of what you think of the current administration, from a business standpoint, the general sense is that, do I have an administration that is likely to increase my regulatory burden? Most
Fees
likely
and so
not,
forth,
right?
taxes.
And taxes as well. Do I have an administration, whether they cut taxes or not, they're not looking to raise my taxes. That's something that corporations are looking at, and they're able to make plans accordingly in a favorable way and be more proactive. So that would argue for a positive climate with or without any sort of future tax cuts, which could be on the horizon as well. If those were to happen, we think that the growth would accelerate. But even without that, the more positive climate from that standpoint, you could continue to see sort of a grinding upward, as opposed to the sharp increases, which is okay,
Which
as
we've
far
seen.
as far as we're concerned.
Is there any one particular industry? I mean, or is it just generally business and industry?
At least for the U.S. stock market, it tends to be technology right now that's driving the stock market. So you have the so-called FANG stocks, Facebook, Amazon, Netflix, Google, Microsoft, that tend to be carrying the market. And that's an important factor, that not all stocks are going up, even though the overall indices are up. So there are isolated parts of the stock market that tend to be carrying the overall market and the indices, but there are other areas of the market that aren't performing well. In particular, the oil stocks are actually closer to a 52-week low. So, but with that, because oil prices are so low, really below $50 a barrel, they've sort of been averaging 45 or so. That is one of the tailwinds that I think people underestimate for the economy, that we have low energy prices, and that helps the U.S. economy. And it's also affected, the U.S. dollar has been a little bit weaker this year, and that's been helping U.S. multinational companies as well. So all of those, factors tend to be supporting the market. But to your point, technology stocks are doing well, some healthcare stocks are doing well, ironically, through all this legislation. But there are a lot of industries that aren't doing well, and the breadth of the market doesn't necessarily mean that this is a broad increase across the board. And that's something, you have to be cognizant of going forward, that not all stocks are created equal.
Explain something you just touched on. If you could explain, the three of you actually, the impact that the lower gas prices and the oil prices. I know obviously home heating oil, for people who still heat with oil, that affects so much of their income. But how does that all work?
Well, it's really helped the consumer because
Right.
gas prices have remained low.
So you're going to travel?
You travel, the costs of shipping things
Shipping, right.
will go down.
Air travel?
Exactly. So that really ripples through the economy when people are able to, as you said, travel. They're able to have lower expenses because commuting can be a pretty big cost for a lot of people. If that can be managed lower, then they have more money in their pocket to shop, buy things.
Yeah.
And so
Looking right at me. Okay, maybe.
So it's, so from that standpoint, it's been a good thing. And also, as Mike mentioned, it has helped to keep the inflation rate low. And because it's kept the inflation rate low overall, the Federal Reserve has looked at that, and they've actually kept interest rates at a lower level for longer, which also ripples through positively if you're in the housing market, et cetera.
Mortgage
Well,
rates are still...
Gary is pointing out some very obvious things about lower prices, but when you think about our economy and how intertwined we are in terms of hydrocarbons and stuff like that, it's in the production of plastics, it's in the chemical manufacturing, it's in manufacturing in general. And in fact, it's interesting to see more and more companies are coming back to the U.S. because of the low energy prices. Natural gas is so cheap right now, and that's an important component in terms of manufacturing.
I think that's a critical point with regard to the low hydrocarbon prices, that one of the things that President Trump is pushing, obviously domestic jobs, companies will come here now because the cost of manufacturing is lower. We can produce energy here, prices are lower, and it makes the ability for the United States economy to produce more goods. And I think this week, personal income was up 2.7%, which was the largest increase in personal income in quite a long time. And 70% of our gross national product, gross domestic product, is a function of the consumer. So to the extent that personal income is increasing, it does tend to be a catalyst for, for certain parts of the economy.
So buy low, sell high.
Well, we're certainly
that
high.
easy.
I don't want to be a killjoy amongst this panel and stuff like that, but I'm very cautious about what's going on right now in the
I think
marketplace.
good
And John Bogle, the former head of Vanguard, he's put out a very, very straightforward methodology in terms of evaluate the marketplace. And it's comprised of three components. One is dividend, how much you're receiving back, company growth, and Gary talked about how things are growing. And last of all is PE expansion, and that's how we measure the stocks.
What's PE?
PE is price over earnings,
Okay.
and it provides us with a gauge in terms of how expensive a stock is. For instance, a stock like Amazon, its PE is 150. It's earning $4 a share, and it's trading close to $1,000 a share. So from that standpoint, I take it back. It's $250 if that's the PE.
Excuse me 1 second. Do I have Amazon?
Well,
Yes, but you also have General Motors,
Right,
which
exactly.
is a PE of
Okay,
5 to 1.
all right,
right,
thank you.
exactly.
So,
Well,
continue,
I think
forgive
the
me for
important thing is that you
interrupting.
have a very balanced portfolio. Okay.
That is an
That's the
Well, when we
important
look at
factor.
each of these components, it's important. Dividends have certainly been pretty good right now, 2.5%.
Yeah.
The growth, companies continue to have increased productivity. But the point that I'm concerned about is the valuation of the overall
Right.
stock market. When we measure this on a historical basis, it's at the second highest level.
And that's scary because
It's very
it's
It
not
is.
going to go up forever.
Right, exactly,
That's-
exactly. In fact, it's 2 standard deviations from its average. So I'm a big believer in mean reversion, meaning that it's something that goes up will come down and stuff like that. I think I'm only pointing out that at this point in time, you need to be cautious. Things are going very well in terms of these macro factors that I discussed earlier. However, I think you have to be cautious in terms of your aggressiveness in terms of your overall portfolio. And that certainly lends yourself to working with a professional in terms of helping. I think that's one of the values that any one of us brings to the table, is that we've seen this before.
Right.
And that as tough as it is, not being participating it is, last thing you want to do is get out. And a lot of it is contingent on terms of your long-term planning.
A lot of people sit home on the computer and do it themselves.
Oh, sure. And more power to them. If they feel comfortable enough to be able to understand these companies and what's driving those, in fact, my youngest was very thrilled because he started buying some individual names, and these are companies he knows. Game stocks, Take
Right.
Two.
But that sometimes is good.
It is very
It's very
good. It's
good.
very good.
Because I
Yeah.
drive him crazy. I'm
Oh,
thinking,
sure.
hey, if I'm shopping there and if I'm using that product,
Right.
then it's for good reason and others are
Right,
too.
right.
Well, Peter Lynch, the great Fidelity manager, was always a proponent of buy stocks that you understand and buy stocks that you use and stuff like that. We believe that too, and I think going back to our not cartoon analogies, but we had Goldilocks.
Yeah.
It sounds like we're a little hot on Goldilocks. It's Goldilocks. We might be a little on the hot, cold,
Well,
and
yeah.
a little hotter on the stock
I'm saying
market.
in terms of there's some very good things about the market,
True.
but there's also other aspects. It's
So-
not too hot, not too
Not
cold.
too cold. Well, I want to talk about the 3 little pigs.
Okay.
And wasn't that the straw house, the wood house, and the brick house?
Right.
And I do agree that we think is, a general firm that we see the stock market potentially going to 25,000 before there's a cyclical reversal because, as Dave mentioned, this is the second longest expansion in history, and the market does tend to be a cycle. But because of all the good things that are happening, we do think it's going to expand for the next year to year and a half. But we do advise our clients, at least, to build a brick house, which means that we do think this can't go on forever because the stock prices are increasing faster than company earnings. So ultimately, we do think company earnings are good, but like the tortoise and the hare, if companies are earning at sort of a moderate pace, but the prices are increasing a little bit faster, that can't sustain itself. So we do need some sort of as Dave mentioned, reversion to the mean, or at least for the market to have its earnings catch up to it over time, and that will occur at some point. We believe probably in 2018 or so. So you've got to be prepared, for that.
That long?
That's what we personally believe, but of course we're not fortune tellers. But based on all the statistics and things that are going on, we do believe we have another year or so left in this type of market before things start to have to adjust, to some sort of homeostasis and whatnot.
I think to piggyback on what's been said about the strong market and making important decisions is the importance of realizing that just because the market is strong, sometimes people can think, wow, this is easy, right? All these stocks are going up, and it's important to make sure that you stick to a certain set of like a value system of sort in terms of the approach, the strategy you take, and not to jettison that plan or that approach just because things are going well. And what do I mean by that? I mean making sure that when you're investing, you're picking companies that are leaders in their field, that we talked about. You could have a sense of what that product is because I use it and I see more and more people using it. You're looking for companies that consistently pay dividends over time. They don't just pay and then the next year they take it away and then they move it again, they pay you again. It's so there's certain criteria that just because we're in a strong market, it seems like all ships are rising.
Guess what?
Make sure you have that sort of plan or philosophy that you stick to, that you're picky. It's still within the universe of options that you have.
We have less than 5 minutes left. So, Dave, let's start with you, and then Mike, your last words on advice to people who are watching.
Well, I think first and foremost, to certainly find an advisor that you're comfortable with, only from the standpoint of serving as a sounding board. It's easy to talk yourself into a stock or a market when you're sitting there on the computer saying, hey, but this is cheap compared to what it was a couple of weeks ago. The thing that I think the three of us all bring to the table is that we've seen it before.
Right,
okay?
like you said.
I mean, we've been in the market, I've been in the market for 35 years and have been through the dot-com, and I must admit it was fun to see that stock go up 2 or 3%. But at the end of the day, when there was no earnings, when it wasn't rational, that's where someone who's a professional who studies this on a regular basis helps out. My only other comment is now's the time to be cautious based on metrics that are out there. And we talked about the various metrics, be it valuations, give it, and the narrowness of certain aspects of technology stocks have gotten really out of hand. So.
Good. Mike, the last couple of minutes?
Yeah, I think I'd echo many of those comments, but to say that everyone's financial situation is different. So to Gary's point earlier, you have to understand what your own goals are, and it may be a time for, if you're at retirement age, to say, hey, the market has done well and it's time to take money off the table or reinvest some of the profits into bonds or take stocks and buy bonds or have cash or precious metals or other asset classes. So, someone who might be 25 years old might have a different strategy than someone who is 75 years old at this point. So part of this whole, equation is understanding your own goals, where you are, what your financial situation is, and most importantly, understanding, can you sustain a dip in the market? Because that's what this is all about. I have no doubt that, like Warren Buffett always says, in 10 or 20 years, the market will be up. Mm-hmm. That part
Be sure about that.
Sure.
It will.
Well,
in the meantime, though, it could be severely down, ebbs and flows, and you need to be prepared for the ebbs more than the flows for the
so
downtime.
the three things: you got to be prepared, you got to be cautious, and you have to really work with somebody who knows what they're doing. If you don't know what you're doing, And my last bit of advice, folks, coming from my consumer background, is as our experts said, you have to protect yourself, and you really have to go with your gut and work with somebody who you really know you can trust. And the best way to find that person is to ask your friends and your relatives, who are they working with, why do they like them, and then when you interview the people with whom you're thinking of working, you ask them, how do you get paid? Do I pay you a fee up front? Do you take a commission? All important things, right? So thank
Absolutely.
you so much for joining us, Dave Henry and Gary Coon and Mike Feiner. As always, great information. Appreciate it. And thank you
Thank you.
so much for watching, folks. Until next time, I'm Susan Wornick.